watching Businessworld Live. I'm Danie Laurel. Happy Monday. It's the start of a new trading week. Let's kick off with our banner story. Economists are forecasting a slower GDP growth in the third quarter following the reimposition of stricter mobility curbs in August. A Businessworld poll of 18 analysts yielded a GDP growth estimate of 4.7% for the July to September period. This is much slower than the 11.8% expansion recorded in the second quarter, which also marked the economy's exit from the pandemic-induced recession. Now, if realized, the third quarter GDP estimate would bring economic growth to an average of 4% in the 9 months to September. This is at the lower end of the government's reduced full-year GDP target of 4 to 5%. Economists said the implementation of enhanced community quarantine in August in the NCR disrupted consumer spending and adversely impacted industrial production. The country's relatively low vaccination rate, as well as inflationary pressures, could continue to weigh on economic recovery for the rest of the year, according to analysts. The third quarter GDP figures will be released tomorrow, November 9th. Now, the House of Representatives is set to tackle measures seeking to either suspend or lower excise taxes on oil as the session resumes today. House Speaker Lord Alan Velasco said Congress wants to be informed of how fuel prices have shot up so fast in just a matter of weeks. He added that the chamber wants to come up with measures to help mitigate this, quote, emerging obstacle to the country's recovery. Velasco also said the House would prioritize the ratification of the proposed 2022 national budget as soon as the Senate passes its own version. Senate leaders earlier said they look to pass the budget bill by the end of November. And with such assurance from the upper chamber, the House Speaker said they see no major stumbling block in having a ratified and enacted 2022 national budget before the year ends. Happy Monday, kicking off the equities report with rallies all around. Let's kick off with the U.S. overnight. You can see there all major indices or benchmarks over in the U.S. climbing to record highs on Friday. The S&P 500 posting its fifth consecutive weekly rally. The sentiment offshore was also further short after announcement of that Pfizer COVID-19 pill. And will we be sustaining the same rally here in the Philippines? You can see that happening, up by 0.5%, strengthening above 7,300 levels. Recall that on Friday we already had that jump. Virus restrictions in the capital region were eased from Friday until November 21st, and that sparked such an excitement. Last Friday, we had a fourth straight day of a climb, the highest close since Feb 2020. That's actually pre-pandemic, and that was led by casinos and property players. So this, according to First Metro Investments' Tina Ulang, the market rally last week was really due to not just the opening of the economy to alert level 2, but also the pleasant inflation surprise that was lower than expected for the month of October. And this, according to BDO's chief strategist, Jonathan Ravelas, he says we can test the 743.40 intraday peak, which we reached over in January. And plus, we also have the GDP third quarter to watch out for tomorrow. And this, however, according to analysts, may actually move the bourse just sideways. We might, however, attempt a breakout above 7,400. So let's take a quick peek at our big movers for the day here. We are 4 minutes into trade. ICTSI leading the charge up 4.1%, followed by PLDT and JG Summit. On the downside, you've got Aboitiz and Globe, as well as Bloomberry, which had, of course, rallied quite significantly last week as our major losers. And finally, just a quick check on the peso. This, as we did see the local unit drop, the largest weekly drop in 6 weeks, as we reported last week, a wider than expected trade deficit on September. It does seem to be strengthening a touch, trading at 50.29 to the greenback. Banks are the main focus in the thick of third quarter earnings season, and here to discuss their performance to date and more, we have with us Patrick Cheng. He's Chinabank's CFO. Good morning, Sir Patrick, and welcome to Businessworld Live.
Good morning, Danie. Glad to be on your show.
Sir, third quarter earnings for the bank, quite happy for you guys, up 29% year on year, and that brings your 9 month earnings up 35% year on year. But what's more exciting here is that the quarter on quarter growth, at least the quarter on quarter performance, has seen growth since the start of pandemic. You've said that this is the only bank to sustain your growth even throughout this difficult period. What is underpinning this?
Well, really, we've been very much more focused on the metrics, no? And going into the pandemic, uh, we're really a we're really heavier on corporate lending, and we have made more strides, to make fixed rate loans. So we don't have too many of those floating rate loans, which would drop immediately. So these fixed rate loans have cushioned us and has helped improve our net interest income. Of course, let's not forget that the BSP has been very proactive in pushing interest rates down. So we and the entire banking industry have also benefited a lot from lower interest rates. So that has given us and everyone else a decent cushion. No? So now I think that we are coming out of this um, this pandemic weakness, and business is normalizing a little bit more. We've seen our fee income improve. The fees, the commissions, these numbers have gone up a little bit more quarter on quarter. So we're very happy about that. We're very focused on keeping costs low, and it's not that we are not spending, but we are spending smart, and we are really putting more um, investments now into our digital platform.
Okay, so we'll get back to your digital platform in just a bit, but you did mention that your bank benefited from the low interest rate environment. Would this be sustainable moving forward, specifically with higher inflation looming here, and even the rest of the world also possibly paring back stimulus, let's say over in the U.S., and we might be keeping in step with that. Are you worried that this might affect your margins in the future?
Well, margins have pretty much peaked right now. No, I think going into the pandemic, our net interest margin, which is the difference between what we earn on loans and investments and what we pay on the interest expense, that net interest margin was around 3%, maybe slightly below 3%. We are now above four. To be exact, we're at 4.2. I think margins have pretty much peaked right now because interest rates have been kept quite low, and the loan rates are coming down a little bit now. As I said earlier, we have a lot of fixed rate loans, but as these loans reprice, the stronger borrowers are able to refinance at a lower rate. So there is pressure on margins, not just on China Bank, but I believe for the rest of the industry.
Okay, and will this pressure, sir, be offset by loan growth? We've been hoping to see that, but you can see on my terminal here, it's still, of course, picking up slightly, but nevertheless still tepid, despite the fact that the BSP has really encouraged lenders to lend at favorable rates. We don't see that pickup now with the reopening of the economy. Are you seeing a market improvement in the loan growth story?
We've seen some loan growth coming back. On the side of China Bank, we are really more focused on the real estate sector. We don't have so much of the unsecured lending, but we believe that as we move out of this pandemic, really the consumer should be able to bounce back. No, so banks with exposure to consumers should be able to get a pickup later on.
So let's talk about provisions. You mentioned that 6.5 billion were set aside, relatively flat versus last year. Is that enough to cover the potential NPL losses, not just this year, but also moving forward if there's a lag in that? And do you see an improvement in the NPL ratios? You mentioned that you're looking mainly at secured lending.
Yes, NPL ratios, we have made adequate coverage. We believe we've made adequate coverage, unless something very bad happens. And a number of banks had lowered provisions this year. We have kept ours quite steady. So we think we are adequately provisioned. The loan book is not as bad. It has been holding up. As I said, we have been lending to corporates, and some of these corporates and conglomerates are the stronger ones financially. So we've been able to hold it, and hopefully, as the recovery picks up, as the economy picks up, then the profits of these companies will bounce back.
Sir, let's talk about your strategy as a bank. You've mentioned again that your strategy is to focus on corporates. Will you be continuing with that strategy? And if so, is there sectors that you are most interested in? With of course the reopening of the economy, when you're focusing on that, and what type of client exposure are you looking at?
Well, China Bank is really around 65% on the corporate lending, probably around 15% on the SME, and 20% on the consumer. So as this recovery comes out, we intend to increase our exposure to the consumer. Coming into this pandemic, um, those with high exposure to consumer were obviously more affected. But I believe as we come out of this pandemic, that same exposure will be helpful, and so China Bank intends to ramp up a little bit, move from 20 probably to 25% in the short and medium term, so that we can ride back the economic recovery.
Sir, tell us more about your digitization strategy. Are you looking at what are you seeing in the future of banks? Will you continue with brick and mortar, with expansion, branch expansion? What is happening now? Are people working from home? Are there more people doing digital banking? Or with the reopening of the economy, are you seeing clients going back to branches? Are you going to go back to business as usual, or is there going to be a major disruption in China Bank?
Okay, thank you for your questions. There are a number of them. I think in terms of brick and mortar, we will continue to have brick and mortar. um, Although we may reposition some of the branches accordingly. But China Bank has around 630 branches, more or less, and we have not really added to these branches in the last few years. No, so we've kept our branches where they are, and digitization has really helped us. I don't think I believe that consumer behavior has really changed. People are just not as comfortable coming back to the branches like before, and so digitization should obviously be a key part of every bank's strategy. So what we have seen is that I think our mobile banking has gone up by around 3 times, and InstaPay use has gone up by around 4 times. So we continue to invest in this and other platforms. So we spend around 8 to 10% also of our expenses on strengthening our digital infrastructure. So I believe it will still be a combination of online and offline. It cannot be fully digital. It cannot be fully branch either, of course. So banks need to have a combination of both to be able to ride the trends moving forward. I don't think, Danny, that you are as comfortable as going to the bank as you were before. And with all the technology now, there really is less and less need for you to go to the banks. Some banks allow deposits now, via check deposits via the mobile banking, and so China Bank will have that soon also on its platform.
Thank you, sir. And finally, just a quick point on your Binondo restoration project. You mentioned that we will not, be fully digital. We still want to go to the bank, and this is, of course, a very interesting way to get people back to your beautiful headquarters built in 1924. Tell us more about that project.
Well, this restoration, has been a long time. The bank had its 100th anniversary in 2020, and going into that, we didn't know that there was going to be this pandemic. So we've planned for this, and it's a restoration on many different points, you know. So there's an architectural aspect to it. We've had a architect noche make sure that we come back to the glory that it was, you know, and make sure that it properly qualifies as a heritage site. So there's architectural, there's structural, there's electrical, there's plumbing, there's a lot of stuff, no. So we've made it, or we are making it LEED compliant, and we've also raised the flooring in the first floor entrance,
Okay.
so that, you know, if floods come in, um, you know, the place won't get flooded. So we've raised the entrance to the first floor a little bit higher, just to take care of that, considering some studies. So hopefully, we are contributing, you know, to the nice restoration and the heritage of the city of Manila, and we're very proud to be part of this. Hopefully, you know, it will be a place that people will look at, and will also tour one of these days.
Exciting times, and we do hope to visit that quite soon and see you there as well in the branch, sir. And congratulations on all of your achievements. That was, of course, Patrick Cheng, Chinabank CFO.
Thank you.
Checking in on the other headlines we're keeping our eyes on, another consortium has submitted an unsolicited proposal to develop the Sangley International Airport. You can see that on your screens here. The group composed of the Cavitex Holdings, Yuchenko Group, Macro Asia, Samsung, Munich Airport International, and the Arab Group submitted their bid to the Cavite Governor John Vic Remulla. They are proposing to partner with the Cavite province for the development, operation, and maintenance of the Sangley Airport. Recall that the provincial government of Cavite recently declared a second failed bidding when it received no bids for the Sangley project after the October 20 deadline. The Securities and Exchange Commission says it has imposed a moratorium on the registration of new online lending platforms of financing firms. This as the Commission crafts new rules that will govern the licensing and registration of these lending platforms. These new rules are seen plugging loopholes that currently allow abusive and predatory lending. Meanwhile, the BSP has signed an agreement with the SEC and other concerned agencies to streamline the process of mergers and acquisitions among the banks. This is in line with the government's goal of improving the ease of doing business in the Philippines. The agencies agreed to cut the total processing time for M&A and consolidation proposals to 55 days from about 160. They also reduced the number of documentary requirements from 58 to just about 30. And that's a first look into the business day. Today's Monday, November 8, 2021. Catch Business World Live for the market close. It's at 3:15 p.m. today. I'm Danie Laurel. Mask on, wash hands, stay safe, Philippines. We are One News.